Good afternoon, everyone. On behalf of the National Institute of Public Finance and Policy, I warmly welcome you all to the Macroeconomics and Policy Conference. The conference is the first in a series of Golden Jubilee conferences being organized by the Institute to commemorate its 50 years of contribution to research and policy making. We are truly delighted to host eminent speakers and panelists over the next 2 days and look forward to rich discussions and meaningful exchange of ideas. We begin today's program with a distinguished lecture by Dr. Amartya Lahiri. It's my privilege to introduce the speaker for today's distinguished lecture. Professor Lahiri is the Royal Bank Professor of Economics at the University of British Columbia. He has previously held appointments at UCLA and the Federal Reserve Bank of New York and served as Director of CAFRA, the research policy institution promoted by the Reserve Bank of India. Professor Lahiri's research spans macroeconomics, international economics, and development economics. He has worked on inflation and exchange rate management, currency and financial crisis, and economic growth. His recent work has examined the distributional consequences of macroeconomic change, including the evolving socio-economic standing of scheduled castes and tribes in India, and rural-urban disparities across India and China. Today, he speaks on monetary policy under oil shocks, a question of acute relevance in today's volatile global environment. Please join me in giving a warm welcome to Professor Amartya Lahiri. The session will be chaired by Dr. Mundle, who will be here very soon. And so as we wait for him, we also begin and he'll join us.
Okay. Well, first off, thank you very much for this very kind invitation, and I'm honored to have been invited. In fact, I should say that the only other time I've given a talk here was about 25 years ago, but my brother was the director at the time, so it felt like a bit of a nepotistic thing. So this one seems much more honest. But so anyway, so thank you very much for this invitation. Let me so as Resham said, I mean, this is a very topical issue. The paper is on monetary policy and I titled it under oil shocks, but it's more general than oil shocks. It's under supply shocks in general. So, oil shocks have, just happen to be one particular example of supply shocks. So I don't know, do I need this? Is it on, or it's blaring red, so I don't know if it's on or not. It's on. Okay. Okay, so I guess the starting point for this paper is that central banks are, basically the first line of response to any time disturbances are coming down this economy, because fiscal policy is slow to respond. I mean, it takes time to organize, legislative action, to enact tax cuts or put in government spending. So central banks and monetary policy in general often happens to be the first responders to disturbances when they happen. And the main instrument that a central bank has, or monetary policy, the monetary policy maker has, is an instrument that is, in the short run, really operates through the demand side. It's a demand side instrument. You're playing with interest rates. You can sort of make credit cheaper or more expensive, and that's going to impact consumption demand. It's going to impact investment demand. So it really is a demand side instrument in the short run. In the long run, it's a different issue about what you can do, but that's not what stabilization policy is all about. So this paper is really about getting hit by high frequency disturbances, and how should the central bank or the monetary policy authority respond to a high frequency disturbance. There are many inflation episodes that when a central bank suddenly confronts rising inflation, it's not a demand side phenomenon. It's being generated by supply side issues. It could be oil shocks, which is what we're talking about right now. Food shocks can be another issue. Suddenly there is a drought, and all of a sudden prices are going up because the monsoon failed. That's a supply shock as well, and it shows up in higher prices. After COVID, we had, when the world economy opened up, we had supply chain disruption, simply because everything got gummed up. And once again, we had a spike in inflation around the world, not just in one country or the other. So, supply shocks are sometimes very dramatic global events, but in a lot of other countries, these are systematic events, which happen because just of the dependence on food and fuel, which tend to move around quite a lot. Those prices tend to move around, fairly frequently. So now, of course, a negative supply shock, it's going to create this, an inflationary impact on the economy along with lowering output. Now, this, introduces a bit of a dilemma for a central bank about how to respond to supply shocks, because essentially, I'll just sort of insult your intelligence a little bit with an Econ 1 kind of graph, that, what's happened is all of a sudden there's a negative supply shock, so you've moved from S1 to S2, and so output has fallen, prices have gone up, inflation is shooting up. You have an instrument that is a demand side instrument. So you can, either move the demand function to the right or you can move the demand function to the left. You lower interest rates, you move this demand function to the right, you cut, to the left, or you cut interest rates and you do the opposite. So basically what it means is that if you try to target inflation at that point, you're going to be raising interest rates, you're going to be reducing demand. You will address the inflation issue, but you're just going to make the recession much worse. And that is the general problem, that if you actually shift demand to D2 by raising interest rates as the policymaker, you're going to create a much bigger recession in the economy than would have happened otherwise. Now, that is the source of the dilemma for the central bank as to should they do something or should they not do something, because, if you tighten monetary policy, you create a bigger recession. If instead you do nothing, you try to say, I'm just going to look through it, that risks de-anchoring inflation expectations. So that sometimes people, if indeed people are forming expectations by looking backwards, you can end up with sort of inflation expectations that start rising because inflation is, no worries, no worries. So inflation begins to shoot up simply because inflation expectations have become de-anchored. So then you let loose these wage price spirals, that wages start rising because people's expectations have gone up about inflation. If wages start rising, then prices start rising because firms start passing on the higher costs, and you get into a bad loop. So what to do? Should you sort of stand pat, not do anything, or should you make the recession worse? And that's the dilemma of dealing with supply shocks if you're a central banker with an instrument that is primarily hitting the demand side. And so the question is, that's what this paper is going to try and sort of address, this question of how best can a central bank deal with this kind of dilemma. Are there some takeaway rules that one can follow in this context? Okay, so one of the things that often comes up around this point is that, so if you just think back to what happened just after COVID, when the inflation spike started globally, most industrial country central banks just didn't do anything initially. They just stood pat, and the main story they were telling everybody is that we are looking through this because it's a temporary supply shock. It's just going to go away. Things are kind of gummed up. It's going to open up. So let's not get panicky and start doing stuff. So we're not going to do anything. But then all of a sudden, after about 6 months of bad inflation print, everybody started tightening. It was a very sharp pivot. And all of a sudden, they were like raising interest rates. And at that point, the narrative suddenly switched because people asked, why are you raising interest rates? Well, because wage price spirals can come up. We are worried about inflation expectations becoming de-anchored. So somehow something had switched. And so that's, the usual issue about not looking through, that if you just keep looking through high inflation print, it becomes, episodes of high inflation are often periods when central bank credibility gets called into question. That if this goes on for a while, the public starts asking, does the central bank even know what it's doing? It's like, maybe it has no idea about whether the shock is coming. In fact, this is an argument that is being thrown at Jerome Powell that, and his FOMC right now, that these guys were just incompetent. And so that's another view, that the central bank just doesn't know what, how to manage. And because the credibility is being judged based on how they perform in managing inflation. And so if you leave inflation alone, even though it's a supply side inflation, and you do nothing, it starts calling into question their central bank credibility, that, whether they're competent, they're incompetent, maybe they're not so committed to inflation targeting at all. high inflation is often viewed as the failure of a central bank. And so that is intricately connected with the credibility of a central bank. And moreover, if expectations are even somewhat backward looking, if you have prolonged periods of high inflation, it starts feeding into inflation on its own, just because expectations start going up for the reasons that I talked about earlier, that if expectations are based on past prints of inflation, high inflation causes inflation expectation to go up. Inflation expectations go up, it starts feeding into wages and prices, and that sort of makes inflation perpetuates inflation, and it just gets into a bad spiral. So for all of those reasons, looking through for extended periods may not be a feasible thing to do. So what this paper is going to be focusing on is like this big question that how should monetary policy respond to supply shocks, to inflation that is driven by supply shocks. So what I'm going to do is I'm going to start with, I'm going to show you some evidence on how important are supply shocks, who do these things matter more for in terms of looking at a cross-section of countries. And then this big thing about expectation formation, that how do people form expectations? So I'll show you some evidence to suggest that there is some interesting features of how people form expectations, at least on from the survey data. And then we're going to use that to inform what kind of model we want to study. And I'll sketch out a little model without, there's going to be a little more detail in the model, but we're going to study optimal policy in the context of a model, which is going to have elements that we're going to be drawing from the evidence. Okay, so I'll start with the role of expectations. So prices and price setting behavior, wage setting behavior, all of those things depend a lot on our expectations about the future. So when unions are negotiating wages or firms are setting prices, expectations about what prices are going to be in the next 6 months become, a paramount, a very big determinant of what sorts of wages and prices are set. So inflation expectations are a key component of price setting behavior. And so if I expect higher inflation in the future, wages start rising, higher wages start feeding through prices due to these, standard markup rules. And so it becomes incumbent upon us to sort of have a better sense of how expectations are actually formed. So what does the data tell us about how expectations are formed? And when do we have any evidence about expectations becoming de-anchored? And so do we see any evidence of that? So I'm going to start by think of a very simple regression. If I have survey data on expected inflation, so I'm going to use that data for 4 different countries. And so if I have expected inflation from survey data, I'm going to regress that on essentially lagged inflation and some measures of real output or labor market conditions. Here I'm going to use vacancy, unemployment rates because I have that. I'm going to do this later for India, where I'll just control for growth because we don't have similar kind of quarterly labor market data that I can use. So I'm just going to use growth rate to control for what's going on the real side. Now, essentially, I'm going to use this kind of specification to think about how people form expectations on average. That they're basing things on what's happened in the past and on labor market conditions. That gives them some sort of long-run mapping that determines how expectations are formed. But then I'm going to be very interested in that last term, the epsilon, which is the residual. Because I want to see how this residual behaves around specific events. The residual is what cannot be explained by the long-run behavior. In some sense, something is deviating from the long-run average. And so during certain episodes, do we see these residuals rising continuously? Do some other episodes create sudden corrections in these residuals? Can we sort of learn something from that? So that's going to be the exercise that we're going to do. I'm just going to run this regression for 4 different countries, and I'm going to extract the residuals, and then I'm going to just plot them for you to see what they look like. So this is the picture that I want you to focus on. So this is a 4-panel picture. So this is Australia, Sweden, the UK, and the US. So I've run this regression from 1996 to 2024. Okay, the regression that I showed you earlier. I've extracted the residuals from that fit, and now I'm just plotting them for a smaller window. The residuals during a particular time period that I find interesting, which is 2018 Q1 to 2024 Q4. I'm just plotting the residuals. And so what should be clear from these graphs, some are choppier than the others, but clearly in the period from 2021 to about 2022 Q2, these residuals were just rising in pretty much all the four panels. You see these residuals. So 2021 is like, you can see I don't have a pointer here, but these residuals are rising for Australia. It's very clear for Sweden, very clear for the US. It's just, they're deviating off from zero. They're just becoming bigger and bigger. And then there is this red vertical line that I've plotted, which is the first period post-COVID that there was a monetary tightening in in each of these countries. So in the US, it happened in Q2 of 2022. Similar, in Sweden, it was Q3. In the UK, it was again Q2 of 2022. So that's when the first tightening happened. So that's the red line. And so what's striking about these pictures is that immediately after this tightening, you see these residuals collapsing back to zero. So the residuals should be anchored around zero. Some period it's a little high, some period it's a little low. So, but if the estimation is reasonably accurate, it should be a mean zero process. So it does fall back in most of these places. If I extend it out, it's like, it falls back towards the zero mark very sharply just around the time immediately after this policy change has happened. Now, you might say that maybe inflation itself came down. And so the next picture is what's telling you what's happening with inflation. What is interesting again is that, again, it's the same plot, but now I'm plotting inflation and not the residuals from that regression. This is actual headline inflation. Inflation doesn't actually turn around for a couple of quarters, sometimes 3 quarters after the first tightening of monetary policy. So after that vertical red line, inflation turns around actually fairly later. But so what is striking about this is that this correction of these residuals, that these inflation expectation residuals collapse down towards zero immediately as the announcement is made. So there are two things to take away from it. That first up, there seems to be consistent with this concern that central banks had that, inflation expectations were becoming de-anchored because of the sustained inflation spike that was going on post 2021. And then the policy pivot that happened when they corrected, when suddenly everybody started raising interest rates, did have an immediate impact that the expectations de-anchoring process got truncated, and it just went right back down towards zero. So the bottom line with this picture is that expectations clearly move about based on past inflation and labor market conditions, but there is evidence that, wage price spirals can happen because, there is evidence from this that expectations can get de-anchored. If you continue with high inflation for long periods of time, expectations start moving much faster. Because remember, when the residual is rising, it's saying that expectations are rising faster than what the rise in inflation can predict. Because inflation is there on the right-hand side. So if the residual is going up, expectations are rising faster than what the inflation process is telling you. And when that thing falls, all of a sudden, it's falling much more than what inflation can predict. And that's the next picture I showed you, that inflation was still rising, and yet the residuals kind of collapsed back down. So clearly, policy announcements have an impact. And if you don't do anything for a while, it does have an impact that, people's expectations start worsening over time. So that's the main takeaway. Now, this is two other pictures. COVID was fairly recent, but sometimes even just baseline announcements of a change in regime can have a similar impact. So this is for the US back in the 1970s. So all of you know that the 70s was a period where there were a whole bunch of oil shocks that hit. From first, there was oil shock 1 in 72, 73, and then there was another one in 78, 79. And inflation was running at double digits in the US, during this period. And a lot of that was attributed to very poor central bank management, FOMC management by Arthur Burns, who was the governor of the Board of Governors at the time, was the president of the Board of Governors, chairman of the Board of Governors at the time. So it was blamed on incompetence, that these guys were just enabling, high inflation because Burns had made poor deals with Nixon. He was just keeling over to, satisfy political demands at the time. And then came Volcker, who was appointed in 1979. And Volcker made a very epochal speech, which was in October, November of 1979. He made a speech that this, easy money period is over. We are clamping down, and inflation is what we're going to go after. That speech, as you can see, now you sort of see that this is, again, the pattern was very similar. The red line is the Volcker speech. And so this is a period from 1977 onwards that these residuals were climbing. They were becoming larger and larger. And then came the speech, and the residuals collapsed, immediately. Somehow there was this signal that was sent out that this easy money period is over, the central bank means business, and people's expectations completely re-anchored almost immediately. That's sort of the remarkable thing, because most of the policy correction actually happened over a 2-year period after that. But the residuals kind of corrected almost immediately. And you can see inflation actually takes a long time to come down. That's the right panel in the US. It doesn't come down right away at all. But it's this impact on what people expect about inflation in the future. The expectation was running about 4 percentage points above actual inflation. So when inflation is running at 10%, people were expecting 14, 15% going forward. As soon as the announcement came in, expectations went right back down to exactly what the actual inflation was, which was exactly this re-anchoring of inflation expectations. There's another episode which I find kind of interesting, which is from India in the 2010s. India between 2008-9 and 2012-13 spent, I think, 5 out of 6 years spent in double-digit inflation. So that was a pretty poor period of inflation management in India, which was, we were essentially suffering from just high inflation for very long periods of time. And you can see this is, again, I ran it for the RBI's. I mean, this is a shorter data, so it's because the RBI has been running household expectation surveys since 2008. So it's a much shorter period, so it's much choppier, so it's not as well identified. Things aren't as well identified. But you can see that the residuals were spiking until this Urjit Patel committee report came out, which came out in like February of 2014 or something like that. And you can see this is like an almost immediate correction where, because the committee made very clear that it should be, they should be targeting, inflation. We should be switching to an inflation targeting regime where the target should be, I think, if I remember right, the 4% is what they had said it was in the agreement, but I think the committee also recommended 4%. So there was a number that people, and, but inflation did not come down to that 4% level for a long time. But if you just go back to just before the committee was, committee report came out, actual inflation is running at 10%, and people are expecting about 3% more than that. The average rate is like, expectation is 13%. And that all just went out. That premium just completely disappeared. That residual just went to zero. Based nothing on, there was no other action except for this committee report, which was like the big thing. And so my focus again is here on how much expectations are moving in excess of what inflation can tell you. So that's about, are my expectations anchored or are my expectations going unanchored? So the main takeaway from this evidence that that I think we took away, and this is I should have said this earlier, that a lot of this is I'm borrowing very heavily from some joint work I've done with Paul Beaudry and Tom Carter in a separate paper. So the main takeaway that we got from this was that expectations are not very well described by pure, full information, rational expectations, which is what most of our standard macroeconomic models impose, rationality on it. Actual behavior and evidence seems to be at odds with that. That full information, rational expectations doesn't seem to, define how, people form expectations. And actually, we are not. There's a lot of evidence. People have sort of looked at survey data to see how do people form expectations, and there is a lot of backward-looking behavior that goes on in describing how people form expectations. However, this evidence is also telling us that expectation formation is not purely adaptive either. And so that's why, people, they put weight on recent inflation outcomes, but if there is some information about the future, they do take that on board. And that was these policy announcements, the Volcker announcement, or suddenly the Patel Committee recommendation, or this one sort of sharp pivot when after COVID, when the central banks tightened, all of a sudden these residuals came down to zero. That's about de-anchoring, or that's about re-anchoring of inflation expectations, where policy announcements have an immediate impact. So it's not as if people are just looking backwards when they're forming expectations. They do also respond to sharp policy announcements or range changes in policy regimes. So it's a bit of a mix of adaptive and rationality. That's what seems to be a better way of describing how people form expectations, that it's not just purely looking backwards. It's not this hyper-rational looking forward. It's some mix of those two things, which describes individual behavior. And so that's what we're going to do. We're going to be looking at an environment where we have a mix of these two things. And I'm going to put a name to this. We're going to work with environments with bounded rationality. It's not going to be full information, rational expectations. It's not going to be adaptive. It's going to be boundedly rational. And that's the world we're going to be looking at. And that choice is sort of informed by what I just showed you, that there is both pieces of that. Inflation expectations do respond to what's happening in the past, but they also respond to if there are sudden changes. Okay, so then the second question which motivated the whole paper is, how important are supply shocks? And where do they matter more? So now food and fuel are among the most volatile items in consumer baskets. Their prices are often driven by global developments, weather-related developments, which is, for food in India, that's always the case. And many central banks actually target core inflation precisely for this reason. They do not target headline inflation, because the difference between headline and core is if you strip out the food and fuel component from headline inflation, you get core inflation. And so oftentimes, actually, most industrial country central banks, they're targeting core inflation, because the argument is precisely this, that our instruments are demand-side instruments, and fluctuations in food and fuel are mostly driven by supply-side shocks. So we are better off targeting core, which is stripping off this kind of purely volatile supply-side stuff, and we are going to be focusing on just the smaller bit. However, households experience headline inflation. Households don't experience core inflation. So there, is a challenge there for a central bank that is targeting core inflation to communicate with the public, saying, we have inflation under control, and the public saying, what are you talking about? I go to the grocery store, I'm seeing completely different things. So you can't be, telling me nonsense, because my life, the life that I'm living, is telling me completely different things. So there is a challenge in trying to match what, the central bank has limited instruments, and therefore it is oftentimes they choose core, but if the headline is doing very different things than core, there is a problem in communication. Where are these problems much more severe? Where headline and core are much more divorced from each other. Where does that tend to happen? Well, that tends to, so if you look at India, headline and core, you can see headline is much more volatile. It's bouncing around much more. Core is much smoother. It's like it doesn't move around quite as much. It's much less volatile. Headline is much more volatile. If I look at a cross-section of countries, to make the point about, where does this difference matter, about headline versus core, this plot is basically, for a set of 19 countries. On the x-axis, I'm plotting the weight of food and fuel in the CPI basket of each of these countries. And on the vertical axis, I'm plotting the average difference in volatilities between headline and core. So you can compute the 24-month window of headline volatility, and you can compute the 24-month window of core inflation volatility, and what's the difference between them. And you take the average of the entire period. This is being computed over the period 1996 to 2024. And so what you see is that countries where the weight of food and fuel is higher is where this volatility gap between headline and core is bigger. So that's this upward sloping relationship. The lower the weight of food and fuel, the less the difference in the volatility between headline and core. The larger the weight on food and fuel, the bigger the volatility gap between headline and core. Now, which are the countries where, is there a systematic relationship between, who has those weights on food and fuel? Which are the countries with higher weights? Well, it turns out the countries with, if you're relatively richer on a per capita basis, the weight on food and fuel is lower. So here, Turkey is the one with the highest weight on food and fuel, which is about 35%. And the weight, as you go to the richer countries, Britain, US, the weight on food and fuel goes down to 15, 16%. In India, it's about 45%. That's the weight of the CPI on food and fuel. So it's much higher than this particular set that we've looked at. And that's just telling you that the poorer the country, the bigger the weight on food and fuel. Therefore, the bigger the greater is the volatility of headline inflation relative to core inflation. And so the bigger you're much more sensitive to supply shocks, because the real gap between these two, headline and core, is the supply side. These are being driven by supply shocks. And so these matter, and the differences become much bigger in poorer countries. This is one of the reasons why the Gurjit Patel Committee actually recommended targeting headline inflation in India, knowing fully well that the instrument was not, as suited to targeting headline inflation, because it's a demand side instrument, and headline inflation often moves for supply related reasons. But the flip side was that people are not going to really believe what we are telling them if headlines moving in one way and the RBI keeps coming out and saying, we have inflation under control because they're targeting core. It's just going to be, some dissonance in that process. So it's not going to build credibility if people don't believe what they're seeing. And so as a result, the RBI, the committee recommended that the MPC target headline inflation, but it opened up this kind of problem that you're trying to, use a policy instrument that is not really very, very well suited for dealing with one of the major reasons why headline inflation moves around, which is supply shocks. Okay, and so that's where we kind of come back. So the long and short of it is that supply shocks matter more where food and fuel have larger weights. These tend to be lower income economies. India has a pretty high food and fuel CPI share. And so the supply shock dilemma becomes much bigger for these kinds of countries, which are dealing with inflationary processes which are being driven by the supply side on a regular basis. The developed guys just faced it during COVID, and now they're facing it due to the Hormuz, the oil shock. These are episodic events which have been highlighted in the data, but on a regular basis, they don't feel it quite as much. But in poorer countries, in relatively poorer countries, this is an everyday thing about dealing with these supply shocks and a very volatile headline inflation, which is mostly supply driven. Okay, so here comes going to be, I'm going to take, what's the timeline? We started a bit late, so I don't know when should I finish it here?
Yeah, another 10 minutes.
10 minutes, okay, yeah. So I'm going to not harass you with too much in terms of Greek letters, but I'm just going to sketch out a model sort of to summarize, these trade-offs and tease out some optimal policy recommendations from it. So this is borrowing very heavily from based on my work with Baudry and Carter. So I'm going to look at a closed economy with households, firms, and a central bank. Households are going to be supplying differentiated labor, which allows them to set wages, because we need some wage setting power to have a wage price spiral. We're going to have firms that are supplying differentiated goods, which allows them to set prices on them. So there's going to be price setting, there's going to be wage setting. And I'm going to have productivity shocks in this model, where productivity shocks are going to be the stand-in for supply shocks. Okay, so this you can rewrite it as a gross output function with oil, and the oil price shock would end up as a productivity shock in the value added function, which is sort of easy to show. So I'm going to cut all of that out. I'm just going to put a productivity shock in there, and that's a supply shock that is going to be moving up or down. And here are the key features that are going to make, these are the key ingredients of the soup. So a model is just like a soup. So sometimes you kind of just, you have the soup, and if you like the taste, you don't want to ask what went into it. But sometimes, you get pushed into revealing the unseemly ingredients. But that's the nature of it. So I would encourage you to just judge it by the taste rather than some of the elements going into it, because you may not like carrots, somebody else might like Brussels sprouts, etc. But anyway, it is what it is. So wages are set before in this model. Wages are set before the shocks are revealed. Okay, so that's a key part. Every period there is a new productivity shock, but the wage setters have to set wages before they see the shock. Price setters get to set their prices after the shock has been revealed. Okay, so this timing creates the link from expected inflation to current wages, because when the wage setters are setting their wages for the next period, they have not seen the shock for the period. So they are basing everything on expected inflation. But of course, once wages have been set, firms are going to be stuck with those wages. They have to, that's they're hiring workers. They have to pay the workers those wages. So then a markup rule, if the wages go up, prices are going to go up as well. So that's the key ingredient for a wage price spiral, is built in with this simple timing convention that wages are being set before the shock is observed and prices are being set afterwards. And I'm going to cut through all kinds of other stickiness issues that typically these monetary models have, which is, I'm not going to have long sticky prices. Every period, everything is getting reset, except for this timing wedge that wages are set before the shock and prices are set after the shock. Okay, so this model, in the paper, there is a whole appendix where I kind of work this out, but the main thing to take away is that it sort of throws out a Phillips curve. So all these monetary models, at the end of the day, come down to usually a 2 or a 3 equation system. So it's a Phillips curve, there is going to be an IS curve, and there is some sort of a policy rule. And if you can write down a model with those 3 pieces, you have a full model. You can then start going to town doing all kinds of experiments. And so all the algebra, I'm not going to tell you, but here is the Phillips curve that this model throws up. And there are 2 pieces here that are worth pointing out, which are different from the standard New Keynesian model that is used to analyze all monetary policy, most monetary policy in, contemporary monetary policies. Papers will have these New Keynesian models, which will also have a Phillips curve, but this is different on 2 margins. First up, you see the subscript T-1, and that bolded E is an expectation operator. So this is pi hat is the expected inflation gap. T-1 is the date at which that expectation is being taken. So what's entering that Phillips curve, the expected inflation for date T, expected inflation gap at date T is based, the inflation gap date T is based on my expectation of the inflation gap at date T. That's that first term. But that expectation is based on information that I have till T-1. And that's coming from that timing convention, that wages are being set before the shock has been observed. And so that spills into, prices, and therefore prices turn into inflation. And so the actual inflation is dependent on the expectation that people have about what inflation they're going to be seeing during the period. Okay, so that's that first piece, which is different from most standard models where this expectation operator is about the future, not based on the past. So people form expectations after having seen everything during the period. So this timing thing is a bit different. The WS is just, whose expectations are these? So these are wage setters. So their expectations are what matters. The second part is the expectation about employment gaps. So that's another key part that always shows up in these Phillips curves, is trading off the inflation gap and the output gap. So that's again, the time when, expectations are being formed is based on T-1. The second piece that is different from most of standard Phillips curves is that there's this minus theta hat T. Theta is the productivity shock, and so theta hat is the shock to the productivity process, so the gap relative to the mean. This usually doesn't show up in the standard Phillips curves. And this is again happening because wages are being set before the shock and prices are being set after the shock. And that's why a shock shows up in a contemporaneous, change in prices, which doesn't happen in the standard model, because there is no mechanism that if we can all set prices after we observe the shock, wages and prices would all move, so everything would get worked out. and so the productivity shock would not show up in the inflation process. So that's the the main thing that I wanted to point out. There's something about a divine coincidence, but I'll avoid discussing that. Okay, so I'm going to talk about monetary policy. I'm going to formalize by this parameter phi. That's the stance of monetary policy. Essentially, the way it is formalized is that the money growth that the economy is choosing, the central bank is choosing, is based on the gap between inflation and the targeted inflation. So if inflation targeted inflation is pi star and actual inflation is pi, then they're injecting money based on that gap, but by how much is being controlled by this parameter phi. The larger is phi, the more aggressive is monetary policy. The lower is phi, the less aggressive is monetary policy. Okay, and so in the reduced form, once you work everything out, it turns out there is a very simple relationship that for any given phi, any given inflation gap, the larger the phi, the more aggressive the central bank becomes, the lower is going to be the employment. Employment, is going to turn negative. So n hat is negatively related to inflation, but by how much, that depends on this parameter phi. If you set phi equal to 0, then you're not responding at all to inflation, and then employment doesn't move. But of course, if you become very aggressive for a small pi hat, if you start raising phi a lot, then your employment is going to drop a lot. So n hat is going to be much more negative. So that's that's induced as the policy reaction function. So now comes the key part, the innovation in the paper, where we abandon rational expectations, and I'm going to introduce bounded rationality through a device called level K thinking. So what's level K thinking? Level K thinking is this idea that we start the period. Every period we're trying to form expectations about the period. So I'm trying to form an expectation about what's going to happen. But for that, I need to form expectations about how all of you are forming expectations. So I'm going to start by sort of having some initial assumption about what your expectations are about when NIPFP is going to shut down for the day. Okay, so if that's when should we all go home? So I need to form an expectation about making my plans. So I have to figure out, I don't want to leave before everybody else. So I need to figure out, I have some expectation about when everybody else is planning to leave. So I need to form an expectation. So I form an expectation of what everybody else is expecting. And then based on that, I can solve models. So I'll solve the model based on that, and I'll come up with an aggregate outcome. And then I'll see how far the aggregate outcome is from what I started with. And then I'll update. And I'll do that. So the first step when I start, that's level 0. The first update I do is level 1. So now if I did this infinite number of times, that's rational expectations. But if I stop without, continuously keep going, I stop at some finite k, that's bounded rationality. I'm not going all the way to the, you can do, sometimes I play these little games with, so if you can ask yourself that we'll play a game where the winner is going to be the one that chooses half the average. You choose a number between 1 and 100, and the winner is the one that is for half the average. So form your guess. What is it going to be? And so, you can start. You say, okay, it's 50. And then, no, but everybody else is thinking the same. Maybe I have to go to 25. That's level 2. You say, no, but everybody else is doing 25. Maybe it's 12 and a half. So level 3. And the people who run these experiments, that, where do people stop? It's usually people stop after 2 or 3. Nobody's, because it asymptotes to 0 if you keep going. That's the rational expectation solution. But it never goes there. In experimental games, it just stops. At after 2 or 3 rounds, everybody stops. And that's level K thinking. So we're going to impose that. It's level K thinking. It's not full rationality that everybody is doing this infinite number of times. So what does that mean? I'm going to put that, the equilibrium system in this model is just these 2 equations, the Phillips curve and this policy rule, those 2 equations. And I'm going to start, it has to start with some initial, level 0 belief. And the easiest level 0 belief is what happened yesterday. That's what I'm going to base. So we just start with that initial seed. So let's say that for my expectation about anything, I start my first level, 0 level, by saying, okay, what happened yesterday is how I'm going to start. So you take that for inflation and for employment, substitute that recursively k times, and those first two equations will turn into those last two equations. Okay? It's just recursive substitution k times, and that's what you're going to get. Okay, what is cool about this expression is that really I've converted all these expectations. This is what the expectation formation is, and it sort of comes down to this. So of course, if you take k to infinity, phi is bounded between 0 and 1. So if you take k to infinity, this whole thing goes away. So that's rational expectations, where the inflation deviation is just the productivity shock for the period, nothing else. And employment deviations go to 0. Okay, because this whole thing within the brackets are going to go away. The expected employment deviations are going to go to 0. That's if you set k equal to infinity. Of course, if you set k equal to 0, that's just purely adaptive. You're just looking at what happened yesterday and you're stopping. So those are the two extremes here, and anything in the middle, you're neither adaptive nor are you fully rational. You're boundedly rational. You're somewhere in the middle. Okay? So that's what we're going to look at finite case. The central bank is going to be minimizing a loss function. It dislikes inflation. It dislikes unemployment. So it wants to minimize losses from employment fluctuations and from inflation, fluctuations. Mu is the weight that it's putting on this employment stabilization. How much does it value stabilizing employment? That's captured by this parameter mu. I'm going to redefine the state variable here to call it x. So that just makes it life a bit more simple. And so, of course, you're trying to minimize this loss function by choosing this monetary policy parameter phi. That's what the central bank is choosing. How aggressively should it play with phi in order to minimize this loss function? And so, when you can write this out in the new, based on this newly defined variable, which is the sum of the inflation deviation and employment deviation, that's x, you can rewrite this loss function. It's going to come out like that. This is the first line. And so you're again trying to do the same thing. Now, you should be, if you just eyeball this, you set k equal to infinity, that's rational expectations. This term, the first term within the brackets on the right-hand side, that goes away. That 2k is gone because it just goes to 0. So then all you're going to be left with is 1 plus mu times phi squared times this sigma squared theta, which is the volatility of the productivity shock. So how do you minimize that? Well, set phi equal to 0. That's the best you can do. Because you don't want any fluctuations in employment. You're not gaining anything by raising interest rates. So you just leave the shock alone. You set phi equal to 0. You don't respond at all to whatever's happening on inflation. Why? Because the first term is really capturing inflation expectations moving around. But under rational expectations, inflation expectations aren't moving. People are very anchored. They understand that this is a shock, supply shock, it's just going to go away. So nobody's expectations are moving around. And then there is no reason for the central bank to be raising interest rates. So they don't do anything. That's the rational expectation solution. In fact, you can show that, that's what I'm showing over there. You can also solve it for the adaptive expectations case. How would you respond? Now you put kind of equal weights on those two things. So it turns out every time there is any productivity shock, inflation goes up, you always respond by the same amount. You get a constant phi, which is somewhere between 0 and 1. Okay? So you don't stand pat and wait. You don't look through. You don't avoid it either. You kind of take some intermediate step at all times. So that's what adaptive gets. But remember, when we started talking about the post-COVID world, most countries were standing pat, saying, looking through, these are supply shocks, and then they pivoted. So it was a period of inaction followed by a sudden response. That's not what adaptive expectations are going to give you. So here, where I'm going to sort of just show you very quickly what happens when you have, very minimal level of bounded rationality. Deviate from adaptive by setting k equal to 1. And I'm going to set beta equal to 0, just a myopic central bank who's resetting everything every period. So it's just, it's just in the paper, actually, we do the whole shebang and the same thing shows up. But you can solve everything analytically with this special case of k equals 1 and beta, which is the discount factor on future, I'm setting that to 0. The optimal policy choice is going to depend on this variable x tilde, which is related to x, which is the sum of the inflation deviation and employment deviation. So it's really being dictated by what's happening to x is really what's happening to inflation. So if you see higher x tildes, it's because inflation deviations have been high. Okay, so that's how you want to think of this. There's a one-to-one map between inflation deviations and this X tilde. It turns out that this model generates multiple equilibria. In particular, the first order condition, if you solve it out, is a cubic. So in general, it will have multiple solutions. And so what we show in the paper is that this is an analytical result, that there are two local optima, two arms, which are, solutions. The optimal solution phi is a function of this inflation shock, called that X tilde. But there are two of these functions. They're both local optima. So we have to constantly check for global optimum. They're not globally optimum. Each one is defining a local optimum. And it turns out that there is a unique point where the global optimum jumps from the lower arm to the upper arm. And that's that darkened, the bolded line in these two arms. You have the dark black line going up, and then it jumps discretely at Z3 on the left panel and then continues. So that's what's happening, that up until X being below Z3, the lower arm is the global optimum. So you stick to that one. And then once inflation goes to Z3 or above, you jump to the upper arm. Policy becomes much more aggressive. Instead of being tepid, that's that sharp tightening that you do. And then this is a one-time jump, and then you kind of go from there. And then it depends on the parameters for mu, how high or how low mu is. Of course, if mu is low enough, then it's all unique. Then you always respond the same way. There is no pivot. So this only happens if you care about employment enough. If mu is high enough, mu is the weight on employment in the policymaker's objective function. That has to be high enough. And if that's high enough, this dilemma becomes a big thing. So why is there this jump? Well, the jump is happening because of a non-convexity here. So if you write out that loss function, there are going to be four pieces. I'm just taking that quadratic loss function and just writing it out, opening it up. And so there are these four pieces to it. The first part is this loss due to inflation expectations moving around. Okay, so that's that 1 minus phi squared times x squared. How do you minimize that piece? Set phi equal to 1. You correct. The inflation expectations are responding to what happened yesterday. So if you raise phi very sharply, you will get rid of that. So that's that first part. So to minimize the first part, you set phi equal to 1. You go to the last one, the last expression on the right. That's the cost of raising. If you want to, if you start raising phi, you reduce output. So that's coming from, if you want to reduce the loss from the output losses due to raising interest rates, you want to set phi equal to 0. So then what breaks this logjam? These two guys are going at each other. They're very different incentives. So the first piece wants phi equals 0. The last piece wants phi equals 1. And then you have that the term in the middle, which is an interaction term, which is essentially turns into a quadratic function, which is a hump-shaped function of phi. So it starts small, it starts rising as you keep raising phi, and then it caps out at some point. So that guy becomes the tiebreaker as to, whether you stick to phi equals 0 or low phi, or do you switch to a high phi. When does that happen? The losses start becoming bigger and bigger. The bigger is inflation. So the larger X is, the losses from doing nothing start getting larger and larger. So at some point, it becomes so large that the optimal phi switches from being 0 to becoming high. And that's this non-convexity that's going on. In fact, this model also generates a soft landing, because there are two costs of raising interest rates. When I pivot, I'm raising interest rates. So there are two things that are going on. One is I'm directly reducing employment. Okay, so tightening policy is causing employment to fall. That's a direct cost. But at the same time, inflation expectations are coming down right away, because as soon as I raise the interest rate, wage setters, their expectations about tomorrow's inflation come down. They're setting their wages, after they've seen the policy. So once the policy has come in, wage setters, reduce their wages, so prices start coming down right away. That causes, employment to go up, because as wages come down, employment starts increasing, because wages are being set at a lower level. So that goes the other way. So the direct effect is causing, employment to come down. The indirect effect, which is going through inflation expectations, is causing wages to come down, which is causing employment to go up. So these two effects in a special case, this special case actually just completely balance out. And so it's a soft landing. When this pivot happens with a very sharp increase in interest rates, output, nothing happens, employment, nothing happens. So this actually has been an enduring puzzle in the West. After the COVID, after the tightening happened, people said this was an immaculate disinflation because it raised interest rates, but no economy slipped into a recession. And so this has been a question about how did that happen? And it's really, this model has one explanation for it, which is it happened because there is a second thing that happens when you raise interest rates. It's inflation expectations that come down. And that causes wages to come down, and that causes employment to go up because that's the indirect channel. And this, in fact, has a long history. Tom Sargent has a whole thing about the end of 4 big inflations, and he has a very famous book where it was all about inflation expectations, that when disinflation programs were put in place, the big thing that changed was inflation expectations. They came down right away, and that made everything optimistic. People started growing from there. So this model has that aspect as well, that it can explain this looking through and a pivot, which is what we were talking about. And it has implications for emerging economies because the threshold for policy action is hit much more often. In the industrial economies, this has been discussed after COVID because suddenly the supply shocks became a big thing, and this is being discussed now. But in emerging economies, this happens all the time. I mean, every 2 years in India, there's discussions about food, monsoon-related food prices, and how should we be dealing with this? Should MSP be kicking in? When should that happen? What is the FCI doing? Are we sort of placing it? This is a regular discussion. India, the consumers are protected from fuel price movements simply through the government not, controlling the price. But food prices are moving around all the time. And so this is more generally true for developing countries, that supply shocks cause these kinds of policy interventions to happen at a much more frequent level. So I think I've gone over. I'm going to stop. And thank you very much for being so patient with some algebra at the end, but I tried to minimize it as much as I could. Thank you.
Thanks so much. It was really fascinating lecture. I do have two very good students. Let's say two questions. I think we'll collect questions and then, yeah, Madhu.
Good afternoon, sir. Thank you for such an amazing presentation. So I have two questions, one pertaining to inflation expectation and the other pertaining to central bank response. And this is very specific to the crisis that we are currently facing. So firstly, in the literature with respect to inflation expectations, we see that past episodes inform a lot of how these expectations work. And given the fact that we have two recent supply shocks that were pretty big, COVID and the 2022 crisis. So in such a scenario, let's say if the RBI raises interest rates, as of now, they're not doing it, but if they raise interest rates, then given the fact that these two episodes just recently happened, could we see a case of overcorrection of demand coming into place? Secondly, RBI right now is not responding to these to the crisis because they're projecting the inflation to be around like 4% target, and it would not sort of breach the 6% threshold, upper threshold that we have. So in such a case, even if you have second round effects, should the central bank still respond by increasing interest rates? Or in such a case, if it's not breaching the upper threshold, should it just let it go and not respond to it?
Thank you, sir. Very thought-provoking. I was wondering that in Indian context, the size of the informal sector is very large and laborers have very less bargaining power. Arjun Sengupta committee said once that 92% of the laborers in manufacturing sector is in informal sector, entire agriculture is informal, majority of service sector employees. So this whole idea about inflation expectation having its effect on the wages and therefore on the prices, how much is it valid in the context of a country like India? And related to that, whether New Keynesian Phillips curve would shape the way it is generally looked at, where in a labor abundant country like India, where unemployment and underemployment is very high, particularly involuntary unemployment rate is very high. Thank you. Yeah, last bit is New Keynesian Phillips curve. I mean, growth can be achieved only at the cost of higher inflation, whether or unit cost of production has to increase in order to increase the level of production, whether that kind of an assumption is valid in the context of an economy where underemployment and unemployment is very high. Thank you.
Oh, yeah. Oh, sorry. And how these things? Okay, great. Hi. A bit of more of a mathematical question. You said that the inflation expectations sort of consistently exceed inflation. I mean, hope I'm remembering this right. Inflation expectations consistently exceed inflation. Seems like it just keeps stretching beyond whatever is there. Have you considered modeling like inflation like in a quadratic term or a power term possibly, and seeing how the epsilon changes then? I had another question, but I ramble, so I'm going to stop. Yeah, it's fine.
One quick question, and your assumption about monetary policy only affecting demand, but we know interest rate affects supply side also. So how do you kind of balance that effect? Because the monetary policy is not just standard demand; it affects investment, consumption, but also assuming that only consumption is affected. That's if you go to standard Keynesian idea, Keynes was against monetary policy because he felt investment is not responding to the basically interest rate changes. So basically, again, that is classic debate between Keynesian and the classicals. And also, as I think was pointed out, that labor unions are not really there in India. And even globally, if you see the membership numbers. Okay, thank you.
It's very interesting, and since I have been working in this field for quite a long time, so it's quite it's very lot of learning from this thing. Thank you so much. My question is basically when a country adopts the inflation targeting policy, so it also gives the weights to both inflation deviation and that's expected from the long-term deviation and the output fluctuation. So it should be, shouldn't it, that particular rule automatically takes care of that at a certain point of time central bank will, so from it can be, so if it just gives a weightage to inflation is the inflation nutter. If it gives only weightage to the output variation, then it's not taking into not responding to inflation. So inflation targeting rule actually takes care of this kind of dilemma where it actually anchors the inflation expectation, helps in anchoring inflation expectation. It tells the common economic agent that okay, over the there can be short-term fluctuations, but in the long run, central bank will always maintain that target inflation rate. So to help people making long-run investment decisions and all. So is it not that that rule per se, which is a Taylor type rule, that automatically takes care of this kind of dilemma that arises when supply side shocks come up?
Professor Mundle, can I? Lekha here. I can't hear you.
Of time, so we'll have to ask Professor Lahiri to respond. We've already got
Okay, so I
a
can't.
whole set of questions.
Okay.
Sorry, my apologies.
Fine. Fine.
So let me start with the last one's the freshest in my mind. So I'll start with that. Inflation targeting is clearly that was the intention, that it's supposed to anchor expectations. The question though is how I guess I'm taking the question at the level of the RBI and how the MPC deals with things. At least my armchair observation of what the MPC does, or at least the governor does. Every press conference after pretty much every meeting, 95% of the questions are on growth, and it has almost very little discussion about what's. So India is an IT targeter, but it seems that. The question is going to be, once it starts breaching, how, and it did breach for a year, it did breach the 6%, and nothing was really called in at that point, because it was, we were supposed to have been explaining things, but it didn't happen. So there's a question of how much it anchors, but that is certainly the idea, that it should anchor expectations. But almost most central banks, we have Sweden in there as well. We had Australia in there as well. So those guys are all supposedly targeting inflation. And you see the same thing, that, as inflation starts, in normal times, these things work quite well. The question is when, suddenly things start deviating, how much of stomach do you have to kind of hold out saying, it's going to come back, so I'm going to, people believe what I said, and these are just supply shocks. At some point, people's, again, it's lives lived. And yeah, the central bank has made some announcement. I never saw anything above 2%, but now it's been like 9 months. I'm going at 7%. This is not looking good. The central bank keeps telling me everything's under control. It isn't. I'm paying much more. And that's when things start getting out of control. There was another theme of these questions about that I think a couple of people asked about the informal sector, labor unions, and the assumptions that went into the specific model about how expectations might transmit to actual prices. Now, some of this is a modeling, as I said. That's why I sort of spent a little bit of time building a narrative about making soups. So, there are all these, when you build a model, you kind of, abstract from things. But prices aren't coming out of nowhere, right? I mean, so people are setting prices. I have my friends who are setting prices for, printed circuit boards when they're supplying. I mean, when somebody is supplying shoes in Agra, he's forming some expectations about, how those costs are. So these expectations are there, whether they're coming through unions or whether they're coming through. I just took the union route, but in day-to-day lives, when we are taking decisions about the future, we are forming expectations. And so a key part in the business world is how firms are forming expectations when they're placing orders, when they're pricing their products. All of that is a function of what their expectations are. So I take your point that, I've kind of modeled it in a certain way that may not be directly, that labor unions may not be as strong. I kind of put it as but you do see wages, tend to rise. And as inflation goes up, wages tend to rise. Now, my father's sitting there. He's a central bank. Everybody looks at, cost of living, dearness allowances are being put in. Where are those things coming from? Where is MSP coming from? How are those politicians who are voting on MSP changes, or, where are those things coming from? They are forming some of it is backward looking, saying what happened yesterday. But there are farmer lobbies who are also asking for prices. How are they lobbying for, what should happen to MSP prices? Those things aren't coming out of thin air. They're coming from expectation formation. Some amount of, that people are asking, demanding, lobbying, and making decisions based on what they expect for the future. So I don't take so I would encourage, I think the way I look at a model is just, it's a dressing for a particular phenomenon about how we set prices. Now, if you just try to follow price setting in an atomistic world where everything is just playing off, this kind of thing will be hard to kind of just show in a model. That's why we've chosen a method. But, in general, expectation formation is a key part of any price setting in any price setting world. The new Keynesian Phillips curve has on the expectation regressions. We actually did have some nonlinear things. We had nonlinear vacancy unemployment rates being put in there just to allow for the fact that there may be different mappings when markets get very tight, when the vacancy unemployment rate goes above 1 versus when it's below 1. Maybe the people's expectation formation changes. We had a quadratic on the inflation process as well, that what past lagged inflation was doing. We had 2 lags as well. So instead of just having 1 lag, none of that matters. It sort of goes. Of course, the more you put in, you kind of suction off. How much you're going to get from one of those things. But in general, at least 2 lags and the quadratic didn't change. Didn't change things. Maybe since we're so short of time, we can chat some of the others I didn't get to, but I thought we can chat over tea or something. Because I don't want to hold up. We're already a little behind.
Thanks.
But we can talk outside. Yeah.
Yeah, thanks. That has really been fascinating. But we are cutting into the next session, and our speaker is here. I'm glad you came. So you heard some of actually Professor Lahiri's view on the present situation, what we should be doing. So thanks very much, and we will chat over tea.